Let's start. Good to see everyone here. 18 people. That's massive. Lots of love and power for everyone. Let's just start addressing this trade I've explained to you guys last week. Pound dollar. Just a simple trade. Following the weakness of pound, strength of US dollar, we're getting we got a bit of correction. Most probably we will get to drawdown somewhere here. Okay, most probably. This is why, I don't know if you guys remember, but I've only entered with 0.25% of risk. Therefore, I'm waiting to place the other 0.75% risk somewhere on here. If I don't get there, then I will place another 0.25 once it breaks here just for a small trade. And if everything continues to be well guided by the Fed this week, okay. For those who are new here, welcome everyone. My name is Luca. I'm a G10 FX analyst. I've been working on hedge funds and so on. And today, every Tuesday and every Thursday, we have webinars. So nice to see a few new names here. Nelson, nice to meet you, mate. Tal, nice to meet you. DR, nice to meet you. So a few new people here. Hopefully we can have a good session and enjoy through it. If you have any questions, please just leave it on the chat, and we'll most probably like few minutes, because I have two screens, so I'm looking at one and then looking to another. I will answer when I have a little of time, so we don't cut the line of thinking. All right, last week someone asked me of course you have questions, man. Of course, Patrick. Man, come on, your questions are good, bro. It's always good questions. Everyone learns. Right, so let's go. Last week, someone asked me about what do I look when I'm doing a macro analysis, right? Okay, so I want to start addressing something here first, right? Most of people think that macro analysis are just looking at an economic calendar. Actually, fundamental analysis are just looking at an economic calendar. But in the actual how can I say, in the actual heart of macro analysis, just a second, guys, I need to find something to put this, just a second. Otherwise, it's going to be a mess. Okay. But actually, there are a few things you need to know about macro analysis. First of all right. So macro analysis, it's also known as macroeconomic analysis. All right. It already suggests to us lots of things. Okay. So it's an approach to analyze the financial market, including the Forex market. All right. It doesn't only suit Forex, it does suit lots of different markets. All right. Basically, we focus on a broad economic factors and indicators to generate our macro analysis. All right. So the goal is to basically understand the overall economic environment and how its potential impact on the currency value, or in a economy that will affect stocks, actual rates and inflation and so on. Okay. I'm going to give a few key components of macro analysis in the context of the Forex trading only. Okay, this is for Forex, because we do have different analysis for all this stuff. Okay, let me just draw it here. Actually, no, I'm gonna draw it on another screen. Just a second. Okay. Can you guys see this? Wait. Yeah, you guys can see this. Okay, cool. All right. So basically, the first thing, we would be looking at the economic indicators. All right, that's the base main thing we will be looking at, economic indicators. All right, there are two things then down here that we will be discussing. Okay, and one of them is the gross domestic product. Okay, or as known as the GDP. Okay, now let me just put this here, and let me do this, just doing some nice things. Okay, right, everyone knows what is GDP, and I've explained this lots and lots of times, but I will explain it again. So the GDP is a measure. Someone is sending questions. Okay, Patrick. All right. The GDP is a measure of a country's economic performance. Okay. Basically, this is what GDP is. Okay. So GDP is the gross domestic. GDP stands for, the acronym GDP stands for gross domestic product, and the GDP is a measure of a country economic performance. Okay, so basically most of the times we analyze the GDP growth rates to gauge how the overall health of an economy is going. The GDP basically is how much they have produced in a time. GDP can be month over month, and it can be as well quarter over quarter, and it can be as well year over year. Okay, most of the people don't know what actually this means, because sometimes we come to the economic calendar and they have the GDP quarter Q4. What is that? I don't have a clue what is that. Well, it's basically the GDP compared quarter over quarter, quarter four of last year. Okay, so what are they doing is, let's say 2023, let's say 2022, we had quarter one, a number of 3.9% growth, 3.9% growth on the GDP, right? Then we came to 2023, quarter one, and we had a minus 1.9% GDP. So basically here we are comparing both of those two. Okay, we are taking quarter one of 2022 and we're taking quarter one of 2023, and we are analyzing, comparing quarter over quarter, and looking at the numbers that we had on quarter two. Was 3.9%, and quarter one of 2022 3.9%, and quarter one of 2023 negative 1.4 and 1.9%. So that basically means that we still sort of negative. We sum up the numbers, and it will come up somewhere at 2.9. 1.9%. But this is what this actually means. Okay, so we're always analyzing how the growth of the country is going. So that's the first thing, one of the economic indicators. All right. Now, the second one I look for is the employment data. Okay, so let me just put it here. Employment data, right? So the employment data basically is the employment figures. unemployment figures such as the non-farm payroll. Let me just put NFP. Everyone knows what is NFP, and unemployment rates. All right. And basically, what it does is it provides an insight into the labor market. Okay. And it does influence the currency value. Now, these are the two most, I would say, important ones, okay? The GDP and the employment data. The employment data, again, it gets to us through the employment figures, such as the NFP, the non-farmer payroll, very common at the US every first Friday of the month. And the unemployment rates as well. So these are the most important economic indicators that are looked to. All right. Now, talking a little bit deeper into that, we have the second one I look for is the interest rates. Okay, interest rates. I think everyone knows what interest rate is. Most probably, if you have been following me for quite a long time, you will know what interest rates is. I've tired of explaining it already and how it's important. But basically, central banks, CBs, right? I've explained this last time. They set the rates, all right? Interest rates. Well, this one, I'm going to be more professional. I'm going to use professional language with you guys. So the CBs, they set the R's, all right? That is the interest rates. Interest rates. And these rates affect the currency values, okay? I've explained already why it affects, all right? I've explained already why it affects, but I'm going to explain it again. So higher interest rates can attract foreign capital, all right, leading to the currency appreciation, while lower rates, it may have the opposite effect, all right? So let's say you were an investor, okay? You were an investor, you have $100 million, you want to put your money somewhere, and you're shopping around on the G10 economies. You have Japan, you have UK, you have US, you have this and that. US have a 5.20. I'm just randomly saying numbers. US have 5.25. So let's draw these here. So US has 5.25%. UK has 7%. Brazil, that is an emerging market, has 12%. And Australia has, let's say, 2%. Okay. These numbers doesn't line up. Of course, Australia would have 2%. Good question. I'm going to explain this soon. Right. So if you are an investor, this is your basket. All right. You're looking to these countries. You're thinking, okay, I have 5.25% on 100 million every year on US. Okay, that's good. But I have 7% on UK. That's better. I have 12% on Brazil. That's much better. All right. And I have 2% only in Australia. Well, I don't want Australia, too low. US, maybe not. Now I have only 2 to decide. Coming to those 2, you're going to come to a conclusion. Which one is safer to invest? Brazil as an emerging market or UK as a G8 economy and a developer market? Oopsie. Developer market. Well, UK is better, of course, because we do get 7%, even though Brazil has 12%, but inflation that is too high. Always on emerging markets, remember, inflation are too high. Therefore, we're going to pick UK. Fantastic. I have my money invested, and right now I have basically 7% every year without doing anything. Well, that's fantastic, isn't it? So I've chosen UK. So basically, higher rates will influence the currency because more people will be attracted to that currency. So more people will be attracted to the pound at that moment there. So let me do a sip here. Very hot here. Anyways, so this is basically another thing I look for. Okay. Now the third is inflation rates. Known as CPI. Right? Most people know this as CPI as well. But inflation rate is different from CPI. Okay, so let me just inflation rate is CPI is higher than inflation rate. Okay, inflation. Okay. Sorry, this one. Okay, so CPI is higher than inflation rate. There's more influence on the market. Okay, so inflation erodes the purchasing power of a currency, and traders, doing the macro analysis, they assess the inflation rates to understand how. No sound. Hello, can you guys hear me? Okay. Let me just maybe you need to join the audio. Right. So they assess the economy through inflation, and they want to understand how this might influence interest rates decision and the currency value. Remember, folks, if we have a higher inflation on an economy, most probably the central bank will hike interest rates. And if we have a lower inflation, most probably the central bank will keep as it is for now. Okay. So what happens when we raise interest rates? Again, we've just talked about higher interest rates. Actually, let me add these here. This is not a rule of thumb, okay, but higher rates, strong currency. Low rates, weaker currency. Okay, this is not a rule of thumb. I'm going to explain why. Okay. Now, besides that, there are other factors involved, such as political stability, trade war, trade deficit, etc. I can write a book. Oh yeah, definitely. We know. I'm going to talk about that as well. We have the trade balances. That's going to be the next one. I'm just talking about after the inflation. We have political stability and economic performance as well. We have geopolitical events. We have market sentiment. We have global economic trends. We have purchase power. We have consumer confidence. We have lots of things. But keep in mind, this is just a just a little toes on the water, so you guys can keep going with that already. So inflation, let's come back to inflation. So inflation, again, as I told, it erodes the purchasing power of a currency, and the traders and the analysts, they assess inflation rates to understand how these might influence the interest rate decision and the currency level. Okay, so yeah, that's pretty much it. Inflation. Number 4. Oh, I have more things. I'm running out of time. Number 4 is trade balances. okay? Most important, the balance of trade, all right, which includes export and imports, all right? So let me change this. Can I change the color like that? Oh yeah, I can. Sweet. All right. So when we have trade balances, what does that mean? What does trade balance means? I don't have a clue. Well, I'm going to explain to you. So basically, it's the balance of trade, all right? The balance of trade, which includes exports and imports, and it can impact the currency. I have a very nice example. If we have time in the end, explain this. A country with how can I say that, with a trade surplus, that basically means more exports than imports, may see its currency appreciate. Okay. All right. So this is a very important thing. All right. And this is one of the things I've talked on my Instagram today. I've mentioned about how, you know, the whole thing on Japan is happening, because think about it. The focus of 2024 will be Japanese corporations, right? Particularly regarding the availability of funds to increase wages in Japan. In the last meeting in July 2023, the yield curve control, they adopt a more, let's say, a more adaptable approach, okay? Being a little bit redundant here. And this resulted in a reassurance adjustment in the spread between the US and the Japanese, Japan interest rates, and made those who were buying US dollars and selling Japanese yens very happy. So when we have companies selling and buying bonds, it's sort of, okay, very, not a sort of, not similar, sorry. But when we have a country with a surplus, with a trade surplus, that means that the country has more exports than imports. So basically, he's selling more than buying from others. This basically means that other people are buying on their currency. Therefore, the currency has to appreciate. If we have an appreciation on the trade balances, if we have a higher trade balances, that basically means that we are on a surplus. And if you are on a surplus, we have a stronger currency, all right? That's a very redundant thing, but this is how it works. Now, let me answer some questions here. I have some questions. So, Patrick, first question. Let's go about this. Let me read it. So my first question, my long-term trade buys for pound yen is bearish. Okay, how to say that? I find myself range trading this pair for the past 10 days, as I do want to leave money on the table, since the market offer you at least 100 pips if you trade the range. What is your projection for this pair in the next few months? Okay. When will you initiate a long-term trade if Borg decides to tighten its monetary policy, or dropping a hint that it will revise up? Actually, I think they should be done already, but just the earthquake there that delayed a little bit. Or you start entering small positions long before Borg. Yeah, that's pretty much what I would be doing. I understand some institutions are doing that, although I do not know exactly how and why they do it so early. Okay, a bit of a complicated question there, but let's break this question down. Okay, so let me copy this. Let me put it here so everyone can see. Guys, if you want to take a screenshot of this, take a screenshot. I'm going to delete soon. All right, 3, 2, 1. Gone. Okay, there you go. This is the question from Patrick. Okay, so my first question. My long-term trend bias for JPY is bearish. Okay, pause here. Let's have a look on this. Okay, pound yen. Okay, pound yen. It is in a very good position actually to enter in a trade because we are ranging, and I do like ranging, as I've just mentioned for you guys last week on pound dollar. We are ranging, and I got into the trade. Now let's assess this. So we have a range here. Okay, what is the volatility from the past 50 candles? So 518. So that's a pretty not volatile from pound yen. They used to be a little bit more volatile, but let's see something here. 518 times 6, that's going to give us 3,100. Okay, 3,100. That's a big number, but I do believe that we may keep going down. Okay, because even though the yen is not that strong at the moment, we do have a very weak pound. Okay, we do have a very weak pound. Let's have a look at the DXM here pretty quick. Yeah, okay, that is a problem there. Retail traders are like massively short and only 20% are long. So you already know what does that mean. In my opinion, in my personal portfolio, I wouldn't trade these for now. I would wait until if you want to express a position through JPY, I would go and choose another pair. All right, being very honest. But this is on you. All right, this is on you. Right, let's come back for the remaining question. So I find myself ranging, yeah, 10 days, yeah. As I do want to leave money on the sensor, if learn 100 pips if you trade the range. Yeah, that's the thing. So if you trade the range, it's sort of a little bit more safe because you're trading support and resistance, but it's still pretty you know, small movements. I don't like to get those small movements. What is your projection for this pair? I don't have much to say on here. When will you initiate a long-term trade if Borg decides to tighten its monetary policy or dropping a hint? I would basically get on USD JPY long. Okay, this is my trade if I want to express anything against the yen. I think that answers your question. Now, next question. When central banks like to quote basis point instead of percentage when they talk about cutting or hiking rates. So basically, you know, I think everyone knows here. Yeah, it will be uploaded to YouTube. So basically, the central bank often uses BPs rather than percentage points when discussing changes in interest rates because base points provide a more granular and precise measure of a rate movement, especially when dealing with relatively small changes. So it's more precise for me to say 1 base point than 0.01%. Okay, it makes the things easier for the desk, as well as it makes it more professional because you do have a language appropriated to that. Okay, so 1 percentage point is equivalent to 100 base points. When the central bank make decisions regarding interest rates, the changes are often in increments that are smaller than 1%. So making percentage point less practical for expressing these adjustments, I would say. So by using base points, the BPS, the central banks can communicate changes in a more detailed and easily understandable manner. So for example, we have a 0.25% change in interest rates. It can be expressed as 25 basis points. If we have a 0.50% change, is equivalent to basically 50 base points. So expressing changes in base points allows for final level of differentiation, which is crucial when we have the context of MP, right, the monetary policy discussions. It's, you know, so this is the main reason. It makes it more precise for them. Makes it more precise for them. Next question. Emerging markets currency has a tendency to get devalue when economy turns bad. Mature market currency are more stable. That's correct. Besides that, there are other factors involved, such as, yes, why Chinese yuan is dropping against US dollar if trade surplus is a deciding factor. There are other factors involved, such as property factor. Yes, in China right now, property is a big thing. I trade Euro JPY too, following smart money concept without following fundamental reasons. Will this webinar? Yes, will. What do you think of Euro JPY? It's currently dropping now. When do you might possibly find support because it's an uptrend market? If you want to buy Euro dollar, how do you calculate stop on ATR? Okay, let me go there. Now, let me share the screen again, just a second. Okay. Few things here, guys. Few things here. Euro dollar. Okay. Right now, for me, in my perspective, you know, it's not a long position because the ECB is more dovish than they were expected to be last week. So of course they paused the rates as expected, but they are being more dovish than, you know, the whole market was priced in. So that basically means that the euro will be weaker compared to the dollar, especially now that the dollar is a very strong. And don't forget, guys, we do have the FOMC this week, so just pay attention on that and see how the German Powell will assess the year 2024 and how this will impact and what are the probabilities of cut or not cut. Now, euro dollar, if you want to calculate the ATR, it's pretty simple. You just do whatever number the ATR gives you times 6. So whatever this number is, whatever this number here is, you just times 6. So 241 times 6, and then this is going to be your stop loss. All right. I think I've already uploaded on YouTube. You can have a look on there. I've most probably it is there already. Let me have a look. Because we've uploaded last webinar in the markets. Where is this? Somewhere here. I just can't find it. Anyways, yeah. So every webinar we upload there, you can have a look on there. How to calculate the ATR. Now let's do a run over. Does anyone have a question about the things I've just explained about interest rates, inflation rate, trade balance, you know, all of those things, or can we move on? Actually, there's another thing I want to teach you guys. Interest rates, you know, most people think that interest rates are one thing, but they are actually completely another. What are your understanding? What are you guys understanding about interest rates? I'm going to give 1 minute so you can write it on the chat and so on. Because, you know, everyone talks about interest rates. Interest rates is this, interest rates, you know, higher mortgages, blah, 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 and blah, blah. But what actually is interest rates? Does anyone know? Because interest rates is a compounding of determinants of factors. Okay. Currency value. That is not right. Let me show you all. Okay. Let me take all of this. Okay. So hopefully my writing is okay and you guys can understand what I'm gonna write it down here. Right, so we call these the determinants of interest rates. Oopsie. Interest rates. Okay. All right, so basically what the economy tells us is that interest rates are set by forces of supply and demand. All right. Where investors supply funds and borrowers demand they use. So this is pretty much what most of people know. Taking the perspective of investors in analyzing market demand in interest rates, we can view the interest rates as the R. Okay, so basically, interest rates in a professional term is called is actually the R. Okay, let me put in red. Oopsie. Okay, so that's the R. This is how it is. Okay. It's basically composed of real risk-free interest rates plus a set of premiums that are required returns on compensation for bearing distinct types of risks. This is what interest rates actually is. Okay, that sounds a bit complicated, I know. But the real maths behind interest rates is the R, okay, equals to the nominal, sorry, the real risk-free interest rate plus the inflation premium plus default risk premium plus the liquidity premium plus the maturity premium. This is what interest rates is. It's a set of those parameters that shows to us how we're going to assess a borrower and a lender. All right. Well, that's a okay. Let me put like this. Okay. So real risk-free interest rates plus inflation premium plus default risk premium plus liquidity premium plus maturity premium. This will actually give us how much interest rates we will give to someone. So if you go to buy a property, if you go to buy a car, if you buy most of the liabilities, you're gonna get a higher interest rates because it's a liability. But if you buy an asset like a property or like a land or like a something that will generate money to you and not actually depreciate, this will have a little bit lower interest rate depending on your case, right? Scenario by scenario is different. But The real risk-free interest rates is the single period interest rate for a completely risk-free security if no inflation were expected. So basically an utopia on the word. So we need to count this as well, because if you're getting a loan, just suppose, okay, just suppose, if you're getting a loan of 1 day in Australia, you won't get a inflation premium because there's no inflation in 1 day, okay? But you will get an inflation premium if you get a loan for 10 years, because the inflation will do vary from 2023 to, 2024 to 2034, all right? Therefore, they need to charge you the inflation premium as well on top of your mortgage or whatever, mortgage you're getting. So in economic theory, the real risk-free rate reflects the time preference of individuals for currency versus future real consumption, right? So we do need to have this. Now, the inflation premium, it compensates investors for expected inflation, and it reflects the average inflation rate expected over the maturity of the debt. So once you get a mortgage, you have a debt, right? Everyone has. So you need to pay this, and you have to pay this with inflation, because your money today is not worth the same in 1 year, all right, or 2 years, but it's going to be worth the same tomorrow and next week and next month. But after 1 year, 2 years, it tends to depreciate a little bit, okay? This is why most of the countries around the globe, especially emerging markets that have a high inflation and they have to charge high inflation premiums on the R, because inflation goes higher too fast, right? Let's take Argentina for instance, right? We're having 100% inflation, close to 100% inflation. Right now, they're getting the money and waiting the money to actually buy a loaf of bread or whatever they want to buy. They're coming back to the barter sort of methodology to buy things on the society. So they're exchanging cows, or they're exchanging pigs, they're exchanging whatever they have with other people as a method of currency. So they're coming back there. So imagining you getting a mortgage in Argentina, I don't even think it's possible, because the inflation premium would be so high and the default risk would be so high that you wouldn't even be capable to actually keep ahead with the payments, okay? But anyways, so the inflation basically reduces the purchasing power of a unity of a currency, all right? The amount of goods and services someone can buy as well. Now, the default risk premium is it compensates the investors for the possibility that the borrower will fail to make a promised payment at the contracted time and in the contract amount, all right? Now, this case, the investor that I'm saying here is the person that put it up the money to someone to borrow. So this is, there's a lots of funds around the world that they do, not only banks, they do have other funds. They are investment funds, mutual funds, and blah blah blah, that they borrow money, they lend money to people to borrow, because this is a good investment, but it can be very risky if the default risk is too high. So everything has to work in a combination, because if you have a higher default, that means that the person that you lend the money, or the family that you lend the money, may not be able to pay. All right, so then who's going to pay it? So that's what I'm saying. When you have a liability like a car, you're going to have a higher mortgage, a higher rate, sorry, because higher rates, they need to be more secure that how much you pay, they at least going to be able to sell your car and get something. But selling a car as a liability, you're going to get depreciated on this on the good that you're selling. It's different from selling a property, because if you have a mortgage for a property, therefore your inflation premium will be okay, your real risk free will be there, your default risk will be there, but the liquidity and the maturity, it's much faster, because right now in Sydney we are short 100,000 properties. So therefore, if I put a property on the market right now, I guarantee you that in a month or two this will be sold, because the supply and demand curve, they're not equally aligned. Therefore, once we put it up something that is an asset, the chances of getting sold is much quicker than the chances of not getting sold. So basically, you need to have this on your maths. Now, what is the liquidity premium? Basically, the liquidity premium, will high GDP lead to increase in inflation? You mean like if a higher GDP, if you have a higher number, will make more inflation? No, it won't. No, it won't, because what GDP is the gross domestic product. Okay, it's how much a population is producing, and then we have the nominal GDP as well. So the GDP, it's basically how much the whole society on that country produced in a period, on a given period of time, a month, a quarter, a year. Compare it to month over month, quarter over quarter, year over year, quarter over month, month over year, year over quarter, and so on. It basically stimulates the economy. So the higher GDP will lead to more foreign investors coming to that country. Why? Because they know if they open a business, the population is producing, and we have a higher chance of succeeding on that country, whatever country. Okay, so no, it doesn't increase in inflation. No. Same goes for lower GDP. It won't deflate economy as well. So I'm just finishing here with liquidity premium. So the liquidity premium basically compensates investors for the risk of loss relative to an investment fair value, if the investment needs to be converted to cash quickly as possible. So basically, let's take the US Treasury bills, right? The T-bills, for example. They do not bear a liquidity premium because they have large amounts, and they can be bought and sold without affecting the market price. Many bonds of small issuers, by contracts, trade infrequently after they are issued. So the interest rates on such bonds includes a liquidity premium reflecting the relatively high costs, including impact on price of selling a position. So if we have a asset that can be sold, as I've just mentioned, the property can be quickly sold, or even, as I've just mentioned as well, the T-bills, treasury bills, or the whatever, the JGBs, USGBs, whatever asset classes we may be talking about, that can be easily exchangeable by cash, go to the market and sell it. Therefore, you don't charge a liquidity premium, because there's so much of that right now that that if you want to sell it, you can just sell it. All right, different than something that there is a higher premium on liquidity, that it's going to be harder to sell it, and therefore it's going to be complex. It may involve all the costs of getting someone to sell it, and it's too much then. So then this is why they charge liquidity premium as well. And now the maturity premium is the simple one. It basically compensates the investors for the increased sensitivity of the market value of debt to a changing market interest rates as a maturity extent. General, holding all as equal as well. So the difference between the interest rates on longer maturity liquid treasuries debt, and that on short-term treasury debt typically reflects a positive maturity premium for the long-term debt. And possibly it does have different inflation premiums as well. So if you have something that it's a 10-year maturity, if you have something that is a 10-year maturity, that basically means that if you want to get your money before 10 years, you're going to have to pay a very, very high liquidity premium. All right. Why? Because you signed a contract to put your money there for 10 years. And now you want to exchange your money. And now you want to get your money back in 1 year. So let's say you put 10 grand, you're only going to get like 9 grand. Okay. Because the investment fund or whatever was counting on that maturity. So therefore, this is why they charge the premium. Okay. And this is why most of the funds, they have especially private equities. Most of private equities, they hold for 7 years, as well as closed-ended funds as well. Open-ended funds are different from closed-ended funds. Closed-ended funds, they go for an investment round. They pick how much money they can, and then they hold this asset for 7 years. And after that, this is how the maturity works. They get the premium and give it to everyone. Open and closed funds, it's just different. You know, you can put money, take money off, whatever you want, whenever you want. Sorry. So this is pretty much how the interest rates actually works. Did anyone know about that? Some questions here. Let me check. I was planning to scalp 50 pips from shorty pound Aussie and pound Kiwi when UK released its poor retail sales figures on 19th of Jan. However, pound did not follow my script, and it does not help me with the positive PMI figures last week. Yeah, but that's the thing. Even though we have a positive PMI figures, it's not working on their favor. So I still keep shorting the pound for now. Along the way, I've had more positions as supported by daily for 1 hour time frame technical analysis. Now I'm sitting on at least 150 to 150 profits. My question: should I close all my positions or leave some profits open to capitalize on the long-term potential? Look, on those situations, what I always do in my case, all right, different from people to people, is I always get some percentage off. It just gonna depends from you, and I drag my stop loss to break even, and I just leave the trade to run. You know, this is basically what I do. The property outlook on the Chinese economy appears murky, and Donald Trump is promising to left China with more tariffs, and if he's elected to the next president, this will affect Australia and New Zealand. Pound is not doing any better if the worst among the three currencies. I would be most happy to know your opinion. Thanks. Yeah, no, I continue to short pound. Continue to short pound in my perspective. Can you recommend books to read on a fundamental analysis? Books for fundamental analysis. I would say economic books. You know, let me see. What's the name of the book? Can't remember. I can't remember. If I remember, I'm gonna send on the Telegram. But most likely, just read like economic books. You know, like just search on Google economic books and try to get involved on those things. I'm asking because some analysts are saying with the US high GDP will make them think twice before reducing rates. Oh yeah, that's different then. That's different. It's not because the GDP is generating inflation. It's because the economy haven't cooled it down sufficiently for them to reduce the rates. So the economy is still in a premium, you know, that they are not expecting it to be. Therefore, they will need to hold the rates until they have a sign of that the rates that they've postponed done, right, 2022, 2023, are affecting the society. Okay, so yeah, this is a different scenario, but no, GDP doesn't affect inflation. Hey Luca, I was later today. Did you talk about FMC news for tomorrow? No, I didn't, but I can talk about that now. I can talk about that now. Not a problem. Let's go for 1 hour and a half today. Okay. Right, there we have it. What time is going to be? It's not going to be tomorrow for me. It's going to be on Thursday for me. What day is it? This is Thursday. Here. It's going to be 6 a.m. Damn, I'm going to be sleeping. Right, so what to expect from the FMC? There are a few things I want to highlight here before we go ahead and discuss about FMC. Most probably, they will keep dovish to neutral. Sorry, hawkish to neutral. Okay, because they are having good data coming in as what's your name? Sorry, as Nelson just mentioned. We had a higher PMI, we had a higher GDP, we had as expected inflation. So I think the whole thing is on US is actually they will come to a conclusion that right now there's no need to raise interest rates anymore, but at the same time the interest rates are not actually getting effective into the economy right at the moment. So the whole speech, you know, you can note it down and ask me later. Probably it's going to be like that. We need more data. We are seeing these data coming high. We're seeing that data coming low. We're seeing that data coming high. Blah blah blah. Therefore, we need to minimize all risks, and we need to confirm more data. But the hikes haven't been out of the table. Okay, so they're just going to mention this. They're just going to drop this bomb up there, but it won't have any, you know, wow difference on a short or long. If we look at the DXY right now, we're ranging bounding. Okay, we did have this up move in the beginning of the year. Okay, all the way to here, but we've ranged on the first weeks. We ranged on the last week of November, January right now. Most probably what can happen here is continue higher, okay? Continue higher until 105, maybe somewhere. If we can break this top here, you know, that's going to be a pretty interesting scenario to see. Therefore, another pause, okay? 5.25, 5.50 still there. Well, the band is actually 52555. So most probably the interest rate decision will be as expected. Just pay attention on the press conference. And another thing I want to pay attention is the what Jerome Powell will talk, and if he will talk about the yearly expectations for the US economy. Most probably he will. And if he don't, someone will ask him. Okay, definitely someone will ask him about what do you think about the cuts in March? Definitely someone is asking this question. Let's just check CMA tool here, just quick. Yeah, you know, 97% of the market is expecting a pause. Now, if we go to March, it's sort of balanced. I sold these at 60%. All right. I sold these at 60% and these at 40. So there are, I still believe, I've been pretty firm on my speech since last year, December, that the US dollar will maintain a strong pace for the first quarter. Okay. Therefore, I'm looking to a cut on the last quarter, on the last month of the quarter, March. Now, just to finish, did that helps? Just want to talk about something here as well. I just want to have another look at the JPY before we go. I've explained this in a video today, but as we hear, you know. So firstly, the outcome of the January MPM, the monetary policy measures, was more hawkish than the market expected. So there was a unexpected pushback against the market, which had factored in that the policy interest rate would be maintained at 0% for the time being, following the elimination of negative interest rates. So I'm looking at trying to price in expectations for future Bank of Japan hikes. You guys maybe notice via the forward OIS rate that the 1 year forward 1 month rate has dropped 0.25%, okay, since the start of the year. I don't know if they have here, but let me check just a second. Japan 1 year. Oopsie. Oh, they have. That's good. Okay. Okay, here. So if you look from the beginning of 2024, okay, it dropped. All right. Now, it basically suggests a strong expectations for the Bank of Japan to maintain the rate at 0% after the elimination of the negative rates. After all, I know it's hard to say, but I don't want to rock the boat for Japanese equities too soon. Given that the existence of an upward bias with forward rates makes me think the market is priced too low. Okay, looking back over the past year alone, I found real challenge in the levels of real interest after the BIA. So essentially, if BIA were to decline, rates could rise significantly. But confirming the volatility by swaption, all right, a 1 month maturity, that cleared up, we'll notice that the volatility of the long-term interest rate has declined rapidly since the beginning of this year. Therefore, similar to what was suggested by the short-term rate, there may have been insufficient caution regarding the January MPM. As a result, the 10-year OIS rate rose to 0.88%. Basically, I think was like 5 basis points after the press conference. From this perspective of the fundamentals, Japan's economy is in a difficult situation at the moment. Therefore, I won't be looking to long Japanese yen. Okay, it's very crucial and exciting price point in today's market. We are preparing to navigate a few new hedges on yen spaces, I would say. Looking ahead, if the view that US will start cutting in mid-2024, the board may be pressure into normalizing the policy by this point, mainly in response to speculative selling of the yen. But remember that the strengthening of the yen was in conjunction with the decline for the US 10-year UST bills, all right, that I've mentioned this last Thursday. And the run of the 10-year JG bills, the Japanese government bonds yields, has been fun to trade so far this year. It was very, very cool. After briefly hitting 0.58% not the 1 year, the 10 year, I mean. But anyways, yeah, for now, I don't like to have short positions on my portfolio expressing through CFDs on JPY. Not now. Therefore, I will continue to long USD JPY. Maybe not now, you know, just see, it is a good price, but yeah, maybe not now. Maybe if we see a retracement. But I want to show something cool for the pound dollar that I'm in a short position. Remember, I've mentioned last week on Thursday that we had what? Oh, okay. It just flipped again. Anyways, don't worry. I was telling you guys that we did had a flip, but this is 4 hours, or is it 4 hours? What about TV? Yeah, majority is too long. Okay. Yeah, I'm gonna keep holding this trade as just mentioned, because I'm expecting the seasonality performance to play out around like 1st of February, 4th February to drop below the 10th of January. So if we have 10th of January here, 10th of January, yeah, below this point here, this is what I'm expecting. If Trump gets elected, will it spook the market like it did in year 2016? If he's lapped tariffs on Chinese goods like what he claimed recently, will it drive inflation rate higher and left Fed with no choice but delaying rate cuts? So all the current market projections on rate cut will be revised again for next year. That's a good question, man. If he puts more tariffs on the Chinese goods, definitely the trade surplus won't be happening. All right, so that no one will want Chinese. So okay, so if he drives inflation rate higher, it won't drive inflation higher. It won't. So the current market projection and rate cut will be revised. No, I don't think so. I don't think so. I would have to get more data for that answer, but just reading like that, I don't think so. Yeah, I don't think so, Patrick. What should we expect from the dollar since it is election year? Well, that's a good question. Volatility, but at the same, not volatility, I would say momentum. No, not momentum, volatility. Yeah, volatility would be the best word. Volatility and uncertainty of the market. Okay. Some people believe that the Trump will gain elections. I've been a little bit off from that, to be honest. I haven't touched base on this yet. Someone sent me a direct message here saying if I could make a PDF of what to look for during fundamental analysis and you put into the group. Thank you. We do have this already. I'm going to send it there to you. All right, guys. I guess this is all from today. 1 hour and 10 minutes of a good meeting.